Hello and welcome to our market alert video for today, which is October 14, 2022. And before I get started, I got to give you some good news. My grandson, who is now a little over 1 year old, took his first steps. So that's major deal. Got the video, got sent to us. The bad news is my wife saw the video and she said, I'm getting in my car. I'm driving 3 hours to go see my grandson walk. So I'm now a bachelor again. The little guy is stealing my wife from me left and right. But I'm going to join them over the weekend. And so I'm going to get to see him too. So it'll be nice. Well, let's go over what's going on. We got some disturbing news with regard to inflation this week. And on almost every metric that you measure inflation by, inflation exceeded expectations. It was higher than expected. The only one where it didn't was gasoline, but many experts are saying that with the OPEC curbing their production, that's going to cause gas prices to go up too. So basically, it's a perfect storm of bad news on the inflation front. And of course, as you know, if that happens, then the Fed is going to want to be more aggressive. And so now the likelihood in November that they raise interest rates by 0.75%, which is 75 basis points, becomes even more certain, if you will. So all of these things are things that we've been saying are coming, and they are, and they have. One thing that we've been talking about in previous market alert videos with you is that recessions are not caused by a lack of demand, but normally they're caused by an oversupply. If there's too much real estate, for example, those of you who lived in states where real estate went crazy, and then all of a sudden there's too much real estate, and then you have a recession in real estate. The Y2K bear market was caused because everybody wanted to have up-to-date technology, so there was a massive oversupply of technology going into Y2K. And then after that, nobody needed anymore for a while. All those jobs had to be laid off. All those companies had to lose profits, and we saw the stock market go down. Right now, as we've described to you, the supply chain issue caused and the pandemic caused companies to say, we need to load up on supply. We need to get ahead of that supply chain problem. And so today we have a record number of inventory, $732 billion of unsold inventories. Never have we seen this in the history of our country, a number that big. And it's televisions, it's clothing, it's across the board. It's not in any particular area. And so what we think is going to happen is that companies are going to have to lay people off. They don't need to make anything. They need to package it, ship it. It's all here already. So we think we're going to see layoffs. Case in point, Intel is announcing they're going to be laying off a bunch of people, unfortunately, because they have an oversupply of chips. They got so many chips, they can't sell them all, and nobody's buying them right now. And so as that happens, we're going to start seeing more and more people lose their jobs. And as that happens, the news is not going to be good. Now, the one thing we always want to remember is that the stock market is not a reflection of inflation. It's not a reflection of unemployment. It's not a reflection of all those things. It's a reflection of profits. So if we have high inflation and high profits, stock market likely is going to go up. But we view that this inflationary trend is going to cause consumers to not buy a lot of that inventory. Companies are going to have to price it down and to get rid of it. They're going to have to lay people off. Their profits are going to come down. And we think the stock market has a leg down to go still before this is all over. Jamie Dimon, who is the CEO of JP Morgan, came out and said, there's another 20% down from here. And he said it's going to be way more painful than the first 20% that we've already experienced. And he was right the first time. And if he's right, then that our view that we could see the Dow at 25,000 becomes a reality. And so if you're over 50, if you are retiring soon, it is imperative in our view that you think about protecting what you have. It's not too late. The market's come down. You may be thinking it's over and all that. We don't think so. And we've seen the bear markets of 2008 last a year and a half. The bear market of Y2K last 2.5 years before it got back to even. And we're only 10 months into this one. So this is not even an old one yet. So I encourage you to visit with one of our retirement planners. We've had our clients out of the stock market since April. And soon after that, we got out of all of our bonds as well, because, as the Fed raises interest rates, bonds tend to go down. And we're in the worst bond bear market since 1949. So visit with one of our retirement planners, get a second opinion. Don't just take a beating and hope it all comes back. That's really not a good financial plan in our view. So our forecast is there's still more storms. We think the recession could get a lot worse before it gets better. And I wish you well. Thank you for watching this video, and we'll talk soon. Oh, our website is rpoa.com, where you can visit with an advisor or learn more about our company. Okay, so go there, rpoa.com. Thank you.